Is the conversation that you're having with your financial advisor always about bigger, higher, greater, better, more? Is everything built around the fact if you get a higher interest rate, you're going to get a bigger pile of money? Hi, my name is Tom Love, and I'm the founder of the Breakaway League. What we do is we teach people how wealth works. We help people understand the implications of the choices they've already made. I'm going to give you just a simple example of what we do. We're going to talk about money, and if I were to ask you a simple question, would you rather be person A or person B because A has accumulated $5 million and B has accumulated $3 million, who would you rather be? Now, because math is math and 5 is greater than 3, the typical response would be, I want 5 million. Now, I've been asking this question for about the last 7 years, and I've been doing this for almost 50. And what I have found fascinating is there's only been a handful of times when someone won't answer the question, they give me a question. And the question they ask of me is just as simple. Where is it? What is fascinating is the people that ask me that question usually have an accounting background. Here's why. Because I believe where your money is more important than what it could earn. Let's assume we follow typical financial advice. We have paid off all of our debt. Our home is owned free and clear. I've accumulated a substantial amount of money. It's in a tax-qualified retirement plan. I have not paid my taxes yet. And I've accumulated a lot of money. This person chose a different route. They wanted to accumulate in a different strategy. So they don't have as much money. So let's talk about first impressions aren't what they appear. Now, there's something called a safe withdrawal rate. When I started back in the 70s, that number was up to 9%. I could take out 9% of an account value and still have an 85% chance after 30 years of still having $1 left. Today, that number has dropped to 2.9. So let's assume I followed typical financial advice. I paid off all of my debt. My largest asset, other than my home that's paid off, is in a qualified account that I have not paid taxes on yet, and I'm going to take out 4% because I've got a great financial performance going on. I'm able to take out $200,000 a year. However, because of what the tax code says, it's now 100% taxed. The tax isn't 100%. 100% of it is subject to the tax. Now, who knows what the tax is going to be? Because I've obviously accumulated a lot. I have to take out a lot because of required minimum distribution. I'm probably going to be in a pretty high tax bracket all of my life. Person B, because they understood how the tax code works, put their money in an account that's treated a little bit different. Because of the way the strategy works, because of the way the Internal Revenue tax these types of distributions, this person could enjoy $180,000 a year. However, this is 100% tax exempt. Not only is it tax exempt, let me tell you the difference between tax-free and tax-exempt. Tax-free is a preference item. You still have to disclose that, put it on your tax return, might be subject to a state income tax, for example, but there is some sort of tax reporting, but there is no tax due on it. This is exempt. There is no 1099. So if this person gets $180,000, $15,000 a month, and that's their only source of income, it's not classified as income. It's distribution of cash flow. Therefore, 100% of their Social Security is free. They qualify for all government assistance. Their Medicare premium is as low as it possibly could be. And they're not filing tax returns. This person has no idea what they're going to owe because the tax is deferred along with the tax percentage. I have no idea what I'm going to owe. So if you think that B is better than A, let's stop for just a minute. Think back of the conversations you've had with every financial advisor that you've ever had an appointment with. Isn't the conversation all about, I can get you a bigger pile of money? I can get you a better rate of return. I can do more and more and more and for what? I can do more with less if less was in the right spot. You do not need a retirement plan to retire. You need money. And where your money is, with this example, is obviously more important than anything it could earn. Quit deferring what you know is going to happen. Because if I were to ask you, do you believe income tax rates are going to go up? I have a feeling I know what that answer will be. Look, if this is of interest to you, I'd love to talk to you. Click here. Let's get an appointment. Let's get together. Thank you.